Thank you for joining us today. Uh, we're going to talk a little bit about rent to own and specifically the homeowner soon path to home ownership featuring rent to own. My name is Terry Heptage. I'm principal partner with HOS Financial. I've been in the industry for a number of years and considered as a rent to own mortgage and credit expert. Before we get into speaking with rent to own, I just ask a question. Have you ever heard anybody say that rent to own is a scam? A lot of times when I present in live audiences, I see people nod their head and absolutely sure that rent to own is a scam, which is great because a lot of times people really don't understand the mechanics of rent to own and the spirit of a rent to own program. My goal with this presentation is maybe change your perception a little bit about what rent to own is, what rent to own means, and how rent to own can be a path to home ownership for you, and really understand how economical rent to own can be as I said, a path to home ownership. So I hope to eliminate some of the notions that rent to own is a scam. The reality of rent to own is that it's been in the market for a number of years. I remember rent to own, it's been around for a long time. My dad used to be a bank manager and he used to do rent to own before CMHC and the insurers were in play. So people had to save 20% down to buy a house. But at that time, they didn't have credit scores. The programs weren't as sophisticated. But rent to own has really grown to be a mainstream product. And as past president of CAROP, which is the Canadian Association of Rent to Own Professionals, I can say with a high level of confidence that rent to own is very relevant and it works for many, many families as a path to achieve home ownership when maybe struggling to get through a bank or struggling to get traditional financing, is a challenge for a consumer, and it is a challenge for a lot of consumers. So when you talk about home ownership, there's two common paths to achieve the goal of home ownership. The first path is the rent, save, and buy model. And this is a situation where somebody feels that they can rent the apartment they're in or the house they're in, they can save the money on their own, and they can buy the property in the open market at some point in the future. As we know, the current market climate, there's some challenges with that, with house prices escaping people and the ability to save for down payment. So the rent, save, and buy model, why it is a path towards home ownership, it has its challenges, and we'll talk about those briefly. The first one is you're subject to rent increases. So if you're renting an apartment, at any time at the end of the lease, you can expect potentially a raise in the rent payment. The savings, if you're looking to rent an apartment and put aside or squirrel away the monthly amount that you need to achieve the down payment for the future home purchase, sometimes that's a bit of a challenge, knowing that there's so many distractions and options and ability to spend your money on something else that a lot of times people fail to have the discipline to save the money they need to get ready for a down payment. A lot of people that go to or are not able to get in through a bank today have credit challenges. So if somebody's renting, saving their money with hopes to get into a home down the road, they need to be associated with somebody who has a skill set or enroll in a program to be coached and guided to improve their credit. And a lot of times people just don't take that on. And unfortunately, they don't understand how to build their credit profiles to meet what the banks are looking for. And when they go to get their mortgage, often they're declined because their credit profile just doesn't meet what the bank is looking for. When you're in a rental situation, there's no equity being built. You're paying a straight rent payment and somebody else's mortgage is getting paid down. The future purchase price that you're looking to buy, a house that you're looking to buy, the future purchase price on that property, depending on how long it takes you to save your down payment, the price of that property may have escaped your down payment savings that you have. So it becomes a little bit of a challenge to continue to save for the down payment for a property where the price is determined by the market and that price continues to climb. The down payment that you will need for that future purchase is 5% or more of the future value. And when you get to the point where you buy the property in the rent, save, and buy model, you're going to pay more mortgage interest because the mortgage you take in the future is going to be higher because of the path you chose to achieve your goal of home ownership. And that path was to rent, save, and buy. The second option that people have is what's referred to as rent to own. Now, with rent to own, you pay a monthly occupancy fee, but there's no change in the monthly payments while you're in the rent to own program. The payment structure is such that it includes a savings component. So when you make your monthly payment through a rent to own program, a portion of that amount is actually considered savings or option credits, and it's added to your starting deposit and accumulates during the term that allows you to save for that down payment when you go for the mortgage in the future. So normally 20% of what you would pay as a rent-own payment is savings. Credit and financial coaching is provided. When we bring clients into a rent-to-own program, the success of that program is only going to be achieved when the client actually exits and gets a mortgage in the future. So we provide credit and financial coaching to allow clients to build the right profile that they need, accumulate the right down payment that they need. So when they go to the bank in the future, they're going to be ready to become the homeowner of the property that they have been renting to own. While in a rent to own program, there is a option to build significant equity, especially in the climate that we're facing today. Property prices are climbing at rates that I've never seen, and in some markets 25, 30% a year. But if you look at a property that's accumulating even by 10% a year, if it's going to take you 3 years to get into that market, and the market has a medium house price of 500,000, you can pretty much bank that that property is going to demand a price in the future of 650,000 if you buy it through the rent, save, and buy model, and you pay market values. With rent to own, we actually cap the future purchase price that you're going to pay for that property. So if the market value and the appreciation outstrip what we have allocated to the appreciation in your rent own program, you're going to build significant equity. And I'll just touch on that just a little bit further. Let's say you're in a market where the property prices are climbing 10% a year, and you're looking at a $500,000 house. In 3 years, using simple math, that property will appraise by $50,000 a year, and in 3 years, the market is going to demand $650,000. If you look at a rent-to-own program with the HOS Homeowner Soon program, we allocate appreciation rates between 3 and 4%. And let's use 4 as the high end. A $500,000 house will increase in price $20,000 a year. So at the end of 3 years, again, using simple math, you'll be under an agreement to buy that house for $560,000. But as I said, the market is appreciating by 10%. So the market value of that property is $650,000, and you're under agreement to buy it for a significant amount less. And the difference between the price that you're under an agreement to buy it for, in this case, $560,000 versus the market price of $650,000, means that when you buy the house in 3 years, it will come with $90,000 worth of equity built in. So imagine that for a second. You're in a rental situation now, and you've had your eye on a house that's currently listed at $500,000. If you stay in the rental position, you're going to pay $650,000 for that property in 3 years. Whereas if you moved in now as a tenant under a rent-own program, you would lock down that future purchase price and know what you paid for it, and it would be somewhere around $560,000. And if the market trends continued and that property appreciated by 10%, you can build significant equity into the purchase when you make it at the rent-own program. A huge, huge, huge value in rent-to-own. Again, the future purchase price is capped, and the down payment you can start today with is as little as 3% as the purchase price versus 5% if you decide to go and buy the house on the open market and get a mortgage through traditional means. And as I said, on the buy, save, rent or rent, say, buy model, you will pay a higher interest. With a rent-own program, you will pay lower interest, and I'm sure you've done the calculation. If you're buying the property at a lesser price, obviously the mortgage amount that you need to take to buy that property is less, and as a result, the interest that you pay over the term of your mortgage is going to be significantly less than if you start it with a higher purchase price. We'll talk about that a little bit more in the presentation. So rent-own, simply put, is a bridge that will take you from where you are today into the ownership position through a path to home ownership that we design for you to make sure that you're ready to secure that mortgage in the future. Rent-own is defined in technical terms. It's a home ownership program where legal contracts are drawn between a property owner or future seller, we call them your investor, and an occupant or a future buyer, and that's the tenant coming into the rent-own program. So there's a relationship between an investor and a tenant, where the tenant moves into a property, pays a rent payment on a monthly basis with the option to buy that house in the future from the investor who partnered with them to allow them to get into the property as a rent-to-own tenant. The tenant occupies the property for a predetermined time with an option to purchase a property using a forward purchase and sale agreement. And in rent to own, the price that you pay for the house in the future is predetermined. So before you start the program, all of the financial terms are agreed to. So you always know what you're going to pay for the house in the future. You already know what your starting deposit is. 3% could be your starting deposit, and every month a portion of your payments is added to that amount. So we know what your future purchase price is, your future down payment is going to be, and we can easily qualify you for a mortgage today based on your information and the mortgage rules in the market today. And we call that part of our exit strategy. The future agreement discloses the future purchase price, the accumulated down payment, and the future sale date. Again, the terms are agreed to before the program starts. So it's not a situation where you come into a program and the house prices really get, they escape and they get really high. It's not that somebody can come back and say, oh, by the way, the house is now worth $600,000 and our agreement says you can buy it for $450. I'd like you to pay $600,000. That can't happen because you're already in the agreement. The purchase and sale agreement is firm from the day you move into the property and occupy it as a rent-to-own tenant with an option to buy it in the future. The tenant will place an initial deposit with the owner at the start, and a fixed portion of their payment every month is added so that it forms the final down payment at the end. Again, I touched on that. If you come in with 3% of today's value, every payment you make, 20% is taken out and added to that original 3%, and it keeps accumulating through the rent-own term, so you know what your down payment is going to be at the back end towards the future purchase price, which I have said is agreed to before we start the program. So who can benefit from rent-to-own? Consumers who are looking for a home today and can't find an approval through traditional means. So we say, don't let others tell you no when you're on the pursuit of buying a property. Let rent-to-own tell you yes. Who uses rent-to-own? Well, there's a variety of people who use rent-to-own. It really depends on the situation and where they are in their path to home ownership. But a lot of people that come into rent-to-own today aren't able, and good quality, good profile clients are being moved into the alternative space, looking for home buying solutions because mortgage rules are very tight. The new stress test coming in June means that you have to be qualified at an interest rate of 5.25% in order to be considered for that mortgage. A big challenge for a lot of people. And what's happening is consumers were ready to buy a property, but now with the changes in the qualifying rules, they're no longer able to fit into the traditional model or through a bank mortgage. And just because the bank says no, consumers aren't going to stop if they're on a mission to buy a house. They're going to be considering and looking for other solutions, other home buying solutions to allow them to get on a path to buy that property. Other consumers who look at rent to own are consumers who have good credit but have less than 5% down. So when you look at rent to own, because it's custom solutions for every client, it really depends on where they are in the path to home ownership. Many can start in a rent to own program with as little as 3% down if their credit profile allows that. People who are new to the country and are looking to get footing into Canada, we love working with new people coming to the country to help them get established and show them a path to home ownership when there are limited traditional options available to them, and those options are getting tougher and tougher all the time. So rent own is very appealing to help clients come in, because part of the rent own program as well is to build the credit profile to make them ready for a bank in the future, so they get the option to move into a property today with a community that they get enrolled to that provides a support mechanisms that allows them to build their credit profile and get ready and position their financial profile so that when they go to a bank, they're ready. Self-employed. People who watch this video who are self-employed, there's a very big challenges out there now getting mortgages. The number of options available to self-employed individuals is less and less. And because of the fact that us self-employed people try to provide our accountant with information, and they maybe haven't claimed enough income to allow you to get into the mortgage of the future. If you're self-employed and you need time to properly declare the income piece as you go through the rent-own term, it gives you time to properly position your income, the verifiable part of your income, the income that you're going to declare, so it matches what the bank looks for on the back end. So we will provide coaching on that. Starting a new career, most lenders want to see people have an established footprint as far as their job and their career, and they look for 2 to 3 years. So if you're fresh out of university, fresh out of trades, and you're looking to start on your path to home ownership, rent own is a great option to allow you to get in and build your job tenure. So when you go to the back end and you go for a mortgage at the back end of the rent own program, the bank will consider you for a mortgage. And clients who have had the unfortunate experience of being in a bankruptcy or a consumer proposal, as you know, if you've ever gone through a bankruptcy or a proposal, the damage to your credit is severe, and many banks will not let you come through their portal until you've been discharged from that insolvency and that you've had time to rebuild your credit. So if you've experienced a bankruptcy or a consumer proposal, rent-own could be a good option for you because it gives you time, and we can set the terms specifically to give you the time to get out of the insolvency event, have the insolvency event purged from your credit report, and build the profile while you're in our rent-own program that allows you to walk into a bank at the end. So just because you've been in a bankruptcy or consumer proposal doesn't mean that you can't get on a path to home ownership, because many do. Common rent-to-own program structures. In the market, there's 3 common rent-to-own structures. There's a tenant first, there's a property first, and there's a sandwich leasing. And the property first is a program where a company owns an inventory of houses, and they look for tenants who are interested in moving in those houses as a rent-own tenant to buy the house in the future. There's another program, a sandwich lease, where a client may not be able to sell their property, and a realtor says, I can bring you a client who will occupy that property, and they will build a down payment and at some point in the future buy it. There's a person in between the tenant and the person that owns the property that's doing the rent-own program. And as far as rent-own programs, history has shown that those are the ones that fail the most often. And then there's the most popular version, which is the Tenant First program. And the Tenant First program is the one that we use. And the reason we do it is because we put the emphasis on the client, because most clients that reach out to rent to own, they're looking to come into a structure where they can be coached, their financial profile can be modified, they can be encouraged, their habits can be changed so that they can get into a much better financial position in the future. And part of that is achieving the home ownership goal. Statistics show that tenant first programs have the highest success rate. because we focus on working with the client. Imagine this for a second. If somebody they were doing a property first rent own, and they had a property for sale, but that person did not have the expertise to coach you for budgeting, to coach you for credit, to coach you how to report your income, to coach you how to build a profile coming out of a bankruptcy or proposal, you would go through that rent-own program and get to the end and realize you wouldn't be able to exit into a mortgage. So we use a tenant first approach to put the focus on the tenant. The property is secondary. We want to have good properties with good bones, of course, that are coming into the program. But there's not much that you can do on the property that makes the rent-own program more attractive. But there's a lot you can do on the tenant side to improve their profile so that when they get to the end, it gives them a much better chance at success in exiting to buy the property. There are two solutions in rent-own. Now, why there's different structures, there's two solutions. One is to help people buy homes, and the other solution is to help people save their home. So if somebody's in an existing property and their financial profile has been derailed by a life event that they weren't able to control, they can still stay in their house, and we will work with them to change them or convert them from an owner to a tenant, enroll them in a rent-own program, and allow them the option to buy that property back at some point in the future. And it's a fantastic product that HOS and Homeownership brought to the market in 2009 to help families when the mortgage rules changed and you couldn't go more than 80% loan to value. A lot of times when you're facing financial disaster, being able to access that extra 10 or 15% equity in your property, it makes all the difference. So we have a great program. If clients are facing power sale or foreclosure, we can help them save their home. And of course, we have the home buying model to help people get into home ownership and rent to own. The original focus is to help people achieve the goal of home ownership. We took that model and modified it to help people who were facing financial disaster or power sale, and we use rent-own to help them there. But we're going to focus mostly on the buying part, the home buying solution that rent-own provides. But no matter which program, the ultimate goal is to make sure the tenant or the person in your program or in our program is coached and given the guidance so that they are ready to get into a mortgage by the end of the rent-own term. It's called our exit strategy. Is what we do to take clients from where they are today to the mortgage of the future, and the process of the exit strategy removes the variables or removes the barriers that they face now to get into a mortgage. So how does rent to own work? This is a simplified approach to it. The down payment to start is 3 to 5% of the purchase price. So if you look at a $500,000 purchase price, the down payment would be simply 3% of that, or $15,000. The payment structure includes a base rent, an allowance for taxes and insurance, and 20% of the total payment is the savings portion. As I mentioned before, when you move in, so in this scenario here, somebody would move into the house, they would put down $15,000 as their initial deposit, and every month 20% of the saving 20% of the payment, which is savings, will be added to that down payment to continue to accumulate to form their final down payment at the end. So a rent to own payment includes a base rent, taxes, insurance, and allowance for the savings component. So if you look at with a total payment of $3,000, the savings portion is simply 20%, or $600 a month. The future purchase price is agreed to in advance. So if you look at a situation where the original purchase price was $500,000 and the appreciation rate was applied at 3% a year, the final purchase price for that property in 3 years would be $546,363. Using some compounding in there, simple math would take it to $545. With the compound, it takes it to $546. So that would be the price that you would pay for that $500,000 house in 3 years, regardless of what the market does. So again, if you're in, some of the major centers, and with everything going on right now in the real estate market with bidding wars and stuff, it's not uncommon to see properties increase in value, and 10, 15, 20% a year. And knowing that you're locked in at 3% a year appreciation is a fantastic opportunity to build equity while you're in a rent-to-own program. The future mortgage, we already know what the future purchase price is going to be. That's decided and agreed to before we start the program. We know what your initial deposit is because that's the down payment you brought when you started the program. And because we know the term of your program and the savings component of your payments, we combine the two, and that becomes your down payment for your future mortgage. So the exit strategy is fairly clear as far as the mortgage piece, because we know the mortgage, we know the purchase price, we know the final down payment, so we'll know the mortgage that you'll need to qualify in the future. And we use your metrics today, like your income and stuff, to qualify you for that mortgage. We know there's going to be barriers that we need to clear, such as credit, job stability, and things like that, but we'll work on that as part of the exit strategy. What we need to understand is it's affordable for you when you come into the program, and that your income is going to allow you to buy that property at the back end after we do all of the work to reposition and restructure your credit and make your profile appealing to the bank. Critical components of any RTO or rent-to-own program: affordability. Everybody that we bring into the Homeowner Soon rent-to-own program must be able to show affordability. There's absolutely no desire to put people into programs where it's really too much to handle. And it is a bit of a challenge because the market today, with house prices, climbing, and people's incomes not necessarily climbing at the same rate, and people want to get into home ownership, sometimes the numbers just don't work. The income doesn't support the price of the house. And why we understand that's the pursuit of home ownership in some cases can be even classified as desperate. It's still on us not to put people in a position where they would be committed to a payment that their income just doesn't support. So we would encourage clients to be able to look at areas where they can move into more affordable housing to match their income level. The exit strategy needs to be predefined. Everybody coming into a rent-own program has some kind of barrier that's stopping them from getting into a bank. And those barriers become the basis for the exit strategy or the planning process to take you from where you are today into a mortgage of the future. 80% of the people that come into our program, they need to fix their credit. So the exit strategy would be to review their credit profile, understand the missing components, what needs to be removed from that report, so that we can put the proper timeline on it or term to build their credit from where it is today to bank ready by the end of the term. And our terms run from 2 to 4 years, 2 to 5 years typically. And it gives, depending on where the client is coming in, it gives us time to build their credit, to accumulate more down payment. A lot of clients come in with a lighter down payment and they have good credit and they need to build their down payment up to 5% or more to go to a bank mortgage. So they use rent to own. Why? To get into the house today, to lock down the future purchase price and get on a path to home ownership, where the exit strategy is going to be to allow them to build their down payment to buy that house in the future. Again, self-employed individuals often need time to declare and show that their business generates the right level of income, and that they're declaring it to the regulatory and to the authorities, to CRA, and they create a verified path of income that allows them to go into a mortgage. And again, people who are starting off new to Canada, new to a job, increase their job tenure. So depending on where clients come in on their path to home ownership, the exit strategy using rent to own is often a custom exit strategy based on their unique position. Properly structured contracts. This one is a key one. many of the lenders and the insurers want to see certain components or certain clauses contained in the contracts that are being used for rent to own. So it's very important to understand that the company you're dealing with has been approved, recognized by the banks and the insurers as a company that provides the components of the contract that each is looking for, so that when you go to the mortgage at the back end of the program, there won't be a challenge for you to be approved based on the fact that the contracts weren't what the lenders are looking for. Make sure that the contracts are properly structured. Mandatory ILA is also a very critical component. At HOS Financial, our homeowner soon program, we are educators. We are here to tell you about rent to own, the features, the benefits, the pitfalls of rent to own, so that you're aware of all the parts around a rent to own program. Now, when it comes down to the legal contracts, we're not lawyers, and we don't want to encourage you to bypass having somebody legally interpret the agreements that we're asking you to sign to start the rent to own program. So we make ILA, or independent legal advice, a mandatory part of our program. Insurance protections, we want to make sure that consumers have the right life insurance and other insurance actually to protect their income, so that if something was to unfortunately happen during the term, that the remaining spouse or the remaining family would have the ability to continue on with the payments, or have the insurance money to be able to buy the property out and achieve the goal of home ownership through that way in the case of a very unfortunate event. Credit coaching, credit improvement strategies. As I mentioned, 80% of our clients that come into 80% of the clients that come into our program need credit coaching. So we create an environment through our Path to Home Ownership program where people are enrolled in a community. They will have access to industry professionals, practicing industry professionals, lawyers, accountants, financial planners, real estate agents, mortgage agents, credit experts. So they get enrolled into a Path to Home Ownership platform where there's a community to support the clients that are coming in and are part of our rent to own program. And a key component of any rent to own program is the credit coaching and the credit improvement strategy, because 80% of the clients that come into rent to own need that. That is the barrier that they need to remove to get to a mortgage in the future. Of course, there are some pitfalls with rent to own, as there are with any financing program. So we just want to touch on some of the pitfalls to make you aware of them, so that if you're considering rent to own through another company other than ours, that these are some of the things you might want to look for. Overstretched servicing ratios, right? We understand that with rising house prices, people still need to find a place to live, and they want to get into homes. And sometimes they feel that they can actually take on the payments, but once they're in, they're stretched a little bit, and eventually they give up and the program fails. So be very careful about being stretched too far on the monthly payment. Lack of insurance, lack of living benefits, and a lot of times, the same as mortgages or any type of financing, often when that financing fails or there's a default, it comes right back to the fact that there was an injury at work or somebody got sick. So having the right type of living benefits insurance to protect you in case that happens, we feel is very important. So make sure that if you're considering rent to own, that you speak with your insurance advisor to have the right protection in place, so that you don't get tripped up as you go through the rent to own program. Short terms. We understand that also when people are looking at getting into a mortgage, they want to be in a rent to own program for as little time as possible. Fortunately for us, we don't waver. We set the term based on the experience we have and the knowledge we have as to how long it's going to take you to get into a mortgage. Because if you shortcut it and you set the term too short, and the client doesn't have enough time to repair their credit, build their job tenure, properly report their income, when they get to the end, they're not going to be able to go into a mortgage. So be careful of short program terms. Low down payment plus bruised credit. Clients entering a rent to own program that have low credit scores and they have a low down payment they're the riskiest files. So if you're in a position where your credit is not that good, if I can encourage you to, to look for a way to bring the down payment up a little bit, because as a rent-to-own provider, building your credit and building your down payment at the same time creates a little bit of a phenomena when you go for your mortgage at the back end, and an underwriter at a lender has two files on their desk, and one file is from a millennial couple who saved their money through traditional means. They have AAA credit and they want to buy a house, through somebody who had bruised credit in the past that used rent to own to build up to their 5%. There's different decisions that might be made at that point for the underwriter. So be careful of, the combination of low down payment coming into a rent own program when you have bruised credit. Over aggressive appreciation rates. Right now, the markets are appreciating at values that are unseen. Our program typically applies an appreciation rate of 3 to 4%. I have seen other programs where the appreciation rate is 10% that's applied, and that's 10% used to determine your future purchase price. So imagine a program where they're charging you 10% on the appreciation, but the average market increase over the last 20 years has been 6%. It's very likely when you get to the back end of the program, the purchase price that you're going to be asked to pay for that property is going to be way higher than what the actual market value of the property is. So be careful of over aggressive appreciation rates. Problematic homes. We ask everybody to do a home inspection. We discourage homes that have problems or could create problems. So, and I understand that, sometimes clients want to go in and they want to do buy a fixer-upper and stuff like that. Unless they have the skill set to be able to go in and do the work, often the home becomes problematic. And if you buy a home that has problems and you're not able to fix them, those problems eventually will overpower your desire to stay and buy that house in the future. So avoid problematic homes at all costs if you can. Poorly structured contracts. Again, we talked about that. Make sure any contract that you have, take it to your lawyer, get their independent legal advice on the contract before you start the rent-own program. And no ILA or coaching program. Again, take the contracts to the lawyer to get their opinion, and look for programs that provide a structure or a community where you can come in and be coached to learn different things about financial profiling, building your profile, building your credit score. It's very important. And again, as I mentioned, 80% of people that come into an RTO program need to have that structure and that credit coaching provided to get them in a position to buy a property at the back end. And this is a mission that CAROP is looking to, CAROP, I should say, is on a mission to change this. CAROP, again, is the Canadian Association of Rent-to-Own Professionals. I sat on that board for a number of years, and my term as president ended last October 2020. And I can say with a lot of confidence that the people who are enrolled in CAROP, the companies that provide rent-to-own services, and they're also a CAROP member, they do rent-to-own right, as they say. They understand rent-to-own, and they have the support, they have the communities within their program, excuse me, that allow clients to exit property. So because the industry is unregulated, CAROP, again, the Canadian Association of Rent-to-Own Professionals, is looking to bring regulation to an industry right now that's becoming very relevant because of the bank rules are so tight. People are looking at other home buying options. So I was proud of being a member of CAROP, and continue to be proud of the people that continue on as CAROP members to bring regulation to an industry that certainly deserves it, because rent to own is a fantastic way to buy a home. So some frequently asked questions, and I'll go down through these fairly quickly. How much do I need to put down? Well, we talked about 3 to 5%. How is the future purchase price calculated? We simply take the purchase price and we apply a moderate appreciation times the number of years you're in the program to determine the future purchase price. And that price is agreed to and goes on the contract is the price that you pay for the home in the future. There's no negotiations later. It's agreed to before we start. So if the property value, the market value is here and the property value is here, this is the equity that you will inherit when you buy the property at the back end. So the future purchase price is calculated by applying an appreciation rate and a term to the original purchase price. HOS, Homeowner Soon, uses between 3 and 4% to set the future purchase price. What are the monthly option credits? With our program and with most rent-own programs, it's 20% of the total payment. Some may go a little bit higher, and we sometimes go higher as well. We give the client more credit for their savings out of the payment because we're looking to build their down payment a little bit higher. But again, it's a custom solution, but typically 20% of your payment is savings, and people refer them as a down payment accumulator, a savings portion, or option credits that you will receive when you exercise the option to buy the house in the future. What happens if I cannot purchase at the end? This one is a very tough question that people like to ask. I always give the fairly standard. There shouldn't be any reason that you can't purchase at the end unless there's some kind of situation in the market, the mortgage rules, or something that you could not have predicted or could not have had any influence over. So if you come into an RTO program and you follow everything, you follow your path, and you get to the end, and for some reason the rules have changed or something has happened in your profile temporarily and you can't purchase, if you've been a good paying tenant through the term, we will extend the term to allow you to get past whatever that bump in the road is that you came across. So if you're, in an example, you're in a community and the factory shuts down, and as a result, property prices temporarily dropped and you got caught when you were about to exit, we would extend the term to allow that to recover. If you have built up your credit profile and, let's say you missed a Canadian Tire payment for $10, that will affect your score. It's not habitual. It's just something that happened. Maybe the automated payment didn't get applied through the server. Again, if you've been a good paying tenant and the spirit of the program has been very positive, we'll extend it at the end to allow you to buy it. Our investors are very socially conscious. They want to have success for our clients. So if we get to the end of the program and there is a bump in the road, we'll extend it to allow you to get past that. Who's in charge of the maintenance? The tenant is in charge of the maintenance. But before we go into any rent-own program, we have an inspection done on the property. So the inspection will show the bones of the property and will show the main components that you and an investor would be concerned about. And that's the windows, doors, the mechanical systems, and the roof. And as long as they're good and the life expectancy of those, go past the term of the RTO program, it shouldn't really be a concern. But as far as cutting the grass, there's a leaky faucet, the refrigerator's making noise, minor maintenance issues like that, that's the responsibility of the tenant. But anything structural to the property that might happen, that's covered through your investing partner's insurance. But you're responsible for the maintenance of the property, and it's going to be your home. So if you want to paint, you want to do some minor upgrades to improve the property, you want to do some landscaping, stuff like that, that's totally fine. Because at the end of the day, again, it's going to be your property. What are the closing costs? Typically, when you look at a rent-own situation, because the investor is buying the property for you to move in as a rent-own tenant, there's no closing costs per se on the mortgage. The investor pays the deed transfer or land transfer tax, the taxes and insurance through the term. But as a tenant, you will be responsible for your down payment. You would be responsible for the cost of doing an inspection. And everybody wants to know that the house that they're buying or going to be living and buying in the future has good bones. ILA, independent legal advice. Typically there's a charge for that somewhere, depending on who the lawyer is in your relationship, a couple $100. And sometimes an appraisal is needed through the financing for the investor. Sometimes the banks cover that cost. Sometimes it's a cost of the tenant. And remember that rent to own is paid in advance. So on the day that your program closes and you get the keys to move into the property, your first payment is due. The same as if you're moving into a rental, first and last month's rent. On the day you move in, the payment is due. Whereas a mortgage is deferred, you move in the first, your first payment is the first of next month. So it's not a closing cost, but it's something you need to be prepared for. So your first rent payment, independent legal advice, appraisal, possibly inspection for sure, and you should be good. Now, with our path to home ownership, if the client is coming in and they have credit challenges, and the exit strategy is going to be focused on matching that client with a debt consultant or a credit improvement specialist under the path to home ownership. If we have to go outside and bring in third party, there may be a small charge for that, but we'll identify that as we go through the program and position it for you to let you know if there's going to be any extra cost. But typically the costs that I discussed are the ones that you're going to need for closing. Again, you're not responsible for land transfer tax or deed transfer tax or legal fees to close the property in the beginning. Who pays for the taxes and home insurance? Through the program, that's the investor's responsibility. You pay for the utilities. So in a rent-to-own program, your cost on a monthly basis will be your rent-to-own payment plus your utilities, including water. The taxes, insurance, and stuff are taken care of through the investor. And you would also have content insurance. So I should probably mention that that might be considered a closing cost up front. You will have to arrange for content or renter's insurance to protect your contents and your valuables. And also with content or renter's insurance, there's a liability rider in there. So if somebody comes and visits your property and they slip and fall, that you have liability coverage in there should they come back and decide that they'd like to sue you for the fall on your property. Can I use my own realtor? Yes, you can. You can use your own realtor. And with our program, you are entitled to go out and search for any property that's on the market that's within the budget that we've identified for you. So if you have an existing relationship with a realtor, we honor that. But remember, when you come into the rent-own program, even though you've been working with this great realtor to find properties and stuff like that, they will not be representing you in the purchase of the property. They represent our investor. So the relationship will change between you and the realtor to our investor and the realtor, but you can still use your own realtor, and you're definitely involved in the process of identifying the property and the price you want to pay for it, especially in this climate with bidding wars and stuff. You want to make sure that the price that's settled on doesn't take you outside of your affordability. What about condo fees? Condo fees are your costs over and above the monthly rent-to-own payment, but sometimes the condo fee includes portions that we've made an allowance for in the payment structure that we put together for you. As an example, when you look at a rental payment, the investor is responsible for paying the taxes, paying the insurance, and paying their mortgage. Well, if the condo fee includes the insurance, we would remove that from the payment structure that we had for your rent-own payment so that you wouldn't be paying the insurance twice. So your actual monthly rent-own payment would shrink proportionally, but there will be an additional cost if condo fees are applicable. So condo fees are for the tenant to pay. So to recap, purchase files, the minimum down payment, 3% or $10,000. It's the greater of. In rescue files and files where we help people save their home through power sale or foreclosure, we'll go 90% loan to value, and we look for there to be at least 10% equity in the property. The purchase price in the future is predetermined. We negotiate that up front, so we know what the price is going to be when you exit the program. And I'll just share a quick story. We had a client exit in a program in London not that long ago, and the exit price was $246,000, and the appraisal was over $700,000. and the math on that is extremely favorable for the tenant. So having the future purchase price predetermined is a major benefit in a market where the property values are growing. The monthly payment includes a base occupancy fee, property taxes, and an allowance for insurance. Plus, the savings component is included in the total payment. So again, when you pay rent in an apartment or a house and you pay it to your landlord, the landlord is responsible for paying their mortgage, taxes, and insurance. In rent to own, the payment is made, the investor pays their carrying costs, and 20% of that total payment is put into a column as a option credit down payment accumulation or savings component that builds your down payment for the future. So the down payment portion of 20% is included in the total payment. Mandatory ILA, again, we want your lawyer to give you advice as to the legal ramifications of the contracts that we're asking you to sign. Credit coaching, again, mandatory. 80% of people that come in to a rent-own program require credit improvement, credit repositioning, and so having credit coaching and mentorship involved in the rent-own program, and we do it through our path to home ownership platform, is critical to the success of the client exiting the program. And again, you pick the property with your realtor so that you pay, you know, the price that is paid for the property. You have say in the price that you pay for the property, and that the home that you pick out is a home that you and your family are going to want and desire to be part of your life for the long term. So you pick out your forever home and move in, but you get the choice as to which property you pick. A little bit about HOS Financial before we conclude. So we have done over 1,000 rent-own programs since 2005. In 2005, we established a rent-own program called Homeowner Soon. From 2005, 2006, we led the industry as far as volume and success rates for rent-own. At that time, there wasn't as many rent-own providers in the space, so we were the industry leader, and in many cases, we still lead the industry. We're the most established rent-own company in Canada, and done more deals than any other rent-own company that we're aware of. In 2009, we introduced the Rescue Refi program. And again, that's for clients who are in trouble with their property. They're maybe losing it in power sale. When the banks changed their rules and restricted the amount of equity people could get out of their house, we designed a program that allowed them to access more equity and maybe avoid a financial disaster. In 2015, we were given Diamond status with CAROP. We were the first company in Ontario to receive that status, and we still maintain a Diamond status with CAROP, again, the Canadian Association of Rent-Own Professional. In 2016, we brought in some new partners as we expanded our incorporation. 2018 and then 2019, and we talk about the projects we were at. And 2019, we investigating new strategies because the market conditions changed a lot in the last couple of years. House prices are growing at rates that we've never seen. Bidding wars, the process to close a deal, and such became a little bit unusual. So we've looked at different strategies to be able to help people still be able to achieve home ownership through rent-own, but adapt to the current climate and the way that deals are being done. Our core values are exit strategy and balance. When a client comes in to a rent-own program, as I mentioned earlier, we must ensure that it's affordable for them and that we have an exit strategy that takes the consumer, takes you from where you are today to ownership of that house in the future. So we want to make sure that the payments that we offer you are comfortable for you and they're manageable, and that there's an exit strategy to get you to a mortgage in the back. So that's a little bit about HOS Financial. 1,000 projects. We can say with a fair amount of confidence that we know what we're doing, and we've helped a lot of people not only achieve the goal of home ownership, but stay in their home when they were facing foreclosure or power sale. So rent-to-own, your path to home ownership. It's a progressive home ownership program. It's an alternative financing solution that's growing in popularity and becoming more and more relevant as banks become tougher and give people more challenges to face when they're looking to get into home ownership. Rent-to-own is an awesome way to achieve home ownership. It's called alternative solution. It's a custom solution. Everybody looks different, but it is a great way to start your path to home ownership. Here's a little copyright content. I'll let you read that just for a quick second. And I want to thank everybody for taking time to review this presentation. If there's any questions that we can help you with, you'll be provided a way to reach back out to us. And we look forward to seeing you on your path to home ownership. Have a great day, and thank you for listening. Bye for now.